good opportunities.
Absolutely.
Definitely. It's where you find the highest dividends in the world. It's where you find companies that have been beat up lately. You see many of them trading at 30%, 40% less than they were at just a few months ago.
Yeah, Steve, I don't know if oil is going to be at $40 a barrel in 3 years. I don't know the future, but I do know that if it is, and even if things stay relatively consistent on the price of the commodity, we're still collecting consistent dividends. And that's important. Even if the market moves sideways over the next few years, we're still collecting the consistent dividends in the Canadian ETNs. Certainly, we personally, as a firm, and Peter, doesn't think oil will be at $40 in 3 years. With the amount of monetary expansion that we've seen here in the U.S. and Canada and everywhere else, there's going to be more dollars, not just U.S. dollars, but Canadian dollars, Australian dollars, euros, more money chasing less oil. And why is there less oil? Because, we've really seen the screws turned on exploration, on new production projects. Those that are already started, that have been started, they're going to continue. But new projects are on hold, and that's what has to happen to see, the next leg up in really what is, we believe, is a long-term secular bull market. So.
Yeah, and I want to touch on real fast the point that John made that, for us, it's okay if the markets go sideways. It's okay if oil stays at 40 a barrel. Because if we can net 9 or 10% in dividend yield, consistently, then that's going to be pretty much any money market we can be in, any bond we can be in, and we're happy to take it. If the market goes up, then we benefit even more. But, in the end, Peter said not only do we invest for the long term, but we never intend to sell these stocks. We ideally hope that you pass these on to your kids and to your grandkids, and they continue earning more in dividend yield than you'd be able to get by sitting in cash or being in bonds. So we turn the traditional philosophy on its head of as you get older, you go from equities to bonds so that you can get more yield and then live off the interest. Our clients are getting the interest the whole way. Whether you're 30 years out and just graduating college like a lot of the people that called in today, or whether you're in your 50s and 60s approaching retirement, you get the income the whole way.
Right.
So,
are you guys suggesting any move? Nothing in either of his books talks about China, it seems. Or at least I didn't see anything much. Do you guys are looking in that direction at all?
Oh, absolutely. I really think that, China as a whole, is going to be, clearly it's been the driver of global growth over the last several years, and we expect that trend to continue. I know that there are, one of our analysts, specialized in Chinese growth stocks prior to coming to Euro Pacific Capital, and some of the reports that he's been turning out on some of the positions that are traded in Hong Kong and Singapore that are focused on domestic Chinese consumption are really remarkable. We're looking at companies that have, net cash positions, above and beyond, anything that you could see here. There's companies, there's a company in particular in Hong Kong that's got a $70 million market cap, Hong Kong dollars, and it's got $140 million in cash. It's, you're basically getting the business for free. If you want to give them a 50 cents, they're going to give you back $1 as an investor. And so that's a pretty drastic example based on, really the liquidation internationally that we've seen, this deleveraging over the last several months, and it's not going to last forever. It's just not. China is going to be a great story, whether you're investing in China today or a year from now. You're making a great decision in my mind for the long term. But, certainly the gains that we've seen, that we think we're going to see, moving forward, right now it's the toughest time. It's the toughest time to pull the trigger and invest because you don't have the track record. You can't look back over the last few months and see a chart. Well, you can't over the last couple months, but over the last year, all the charts are going in the wrong direction if you want to be holding these stocks for a long time. But at that point, when you understand the fundamentals are so compelling, that's when you start wading back into the market. That's when you start saying, okay, this actually feels good. And why does it feel good? Not because I just hope that these stocks go higher, but because I'm using my own faculties to see that the fundamentals of these companies and of the country as a whole and the global economy as a whole are certainly much more solid than what you're going to hear on CNBC.
Yeah, and Steve, a lot of times Peter doesn't talk about China directly because Americans actually can't invest through the Shanghai market. You can't buy A shares. What you can buy is 8 shares through Hong Kong, or another great way to get exposure to China is through Singapore. So when Peter talks about Australia, Singapore, Japan, Europe, a lot of times he's factoring in the performance of companies in those nations because of the export potential to China. What we see in China is still tremendous growth. and we anticipate that to continue. You know, they put $500 billion every year into infrastructure. You know, they're building roads. We invest in infrastructure. They're building, telephone wires and pipelines. And, you know, what do you need for that? You need raw materials. You know, you need copper and nickel and zinc, and you find that in Australia. You see a water crisis in China. You see that, 50% of the rivers and lakes in China are polluted. The Yellow Sea is almost unfishable. And a company that we have in Singapore goes in there, and they provide, utilities that can filtrate this water and actually create something that you can drink. So, they benefit from the water crisis in that country. You see a company in Japan that is building containment cells for nuclear reactors as China, by the year 2020, is ramping up to, possibly 10% nuclear power production. So all these companies indirectly focus on China. And so when he talks about Japan, when he talks about Australia and Singapore, indirectly you can kind of read between the lines and see that it is driven by China.
Yeah. Okay. Thank you very much.
Mm-hmm. Yeah, thanks, Steve.
Thanks for your calls. Appreciate those, thanks for your questions. Appreciate your call. All right. Next on the line is Matt in Virginia. Matt,
Hey there. Can you hear me?
Yeah, we can hear you, Matt. Happy New Year's.
Happy New Year's to you. Thanks for having me on the show here. I'll keep my question short so you can have additional time. I've got a Roth IRA account, and a neglected one at that. The balance is under $2,000, and basically, with the way the market has been, I'm wondering if it would be good to leave it be and continue to contribute, or whether right now it would be good to try and pick up, an ounce and a half of gold, or as much as I can. And the first quarter of next year, my company that I work for will have an IRA they can set up through New York Life, and contributions can be done and taken out of my payroll. I could roll my existing over into that, the balance from the old account to the one provided by my employer, but with the way gold prices are looking to be in the future, I just kind of wondering what I should do with that little neglected Roth IRA that I have.
Yeah, it's real difficult to hold physical metal in an IRA, as I'm sure you're aware of. And the alternative for a lot of investors has been to buy derivatives. They look at buying GLD, or if you wanted to buy SLV or one of the other, investment products out there that derive their value off of gold, which is ultimately where you want to be, right?
Mm-hmm. Right.
So, the challenge becomes, do you take the penalty? Do you keep the accounts, under the kind of the government, oversight of the IRA? I know it's probably not going to happen. Let's hope not. But when we see things like we saw out of Charlotte, where they were debating some newspaper article I saw, and you can certainly email me and I send it to you, where they're debating taking 50% of the value of IRAs and stuff like that. It's just when I see stuff like that, I mean, at first you shake your head and you think, well, this could never be an issue or never be a problem, but boy, times are very interesting. And so, it's really hard for me to say specifically if, you're going to really, see a detriment if you invest in those derivatives. Have you read Crash Proof, Matt?
I have not. I should be picking that up here shortly. Yeah. So
one of the things that that Peter talks about is the risk of investing in derivatives, and that's always a something that you just what do you believe? What do you believe? I have some clients who rather than buying an ounce of gold, they like to buy a book on gardening and a gun. I have other clients. So it's really, where do you stand on the spectrum? And I can't tell you what you feel. You just have to really search your own faculties in your own mind and decide, hey, is this worth it to me to pay this penalty to pull the money out of this IRA to invest in something more tangible than a derivative? And ultimately, you're going to have to make that decision. We can't make it for you. I certainly don't want to advocate, taking a penalty, at this point. But at the same time, I think that the physical metal, clearly, if the message is, it's certainly much better to be in a physical product as opposed to a derivative, especially in times like this.
Yeah, and Matt, the good news is that you actually can invest in physical metal through an IRA. There's a company called Sterling Trust that we work through, and we can set up accounts. So, if you'd like to, that could be an option for you. For First Mint, you actually do have to put in at least $10,000, so consider that. So anyone out there that has an IRA and they want to buy physical, they can do it. The good thing about the Roth IRA is you've already paid, your taxes on it, so you're going to take about a 10% hit. But see what your investment options are. Keep the company, keep the IRA wherever you have the most investment options. In some cases, you can buy, certain funds that are going to track the price of gold. That could be a good option for you to consider.
Absolutely. So we're winding it up. I want to say that we appreciate every